Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Robinhood markets.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. If there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. And I think the central story here isn't just about one good quarter. It's really about a fundamental shift in the company's profitability.
Okay, let's unpack this because the headline numbers from Q3 2025, they were just staggering. We saw a 100% year-over-year revenue increase.
100%. I mean, Q3 revenue hit $1.27 billion.
Right, and that completely blew past the consensus estimates, which were, around $1.15 billion?
Exactly. But, that top-line strength, as good as it is, translated directly to the bottom line. And that's where things get really interesting. That's where you see the operating leverage.
And that's the key term, right? Operating leverage. The EPS for Q3 was 61 cents.
Massively exceeding the 41-cent estimate. That's a 48, almost 49% beat.
Wow. And this wasn't just a one-off thing. It came after a really strong Q1, which was already kind of showing acceleration.
It was. But here's where it gets, like you said, really interesting. The net margin.
Okay.
It expanded dramatically to 52.19% in Q3.
52%?
Yeah.
So for every dollar that comes in, over half of it is pure profit.
That's it. And that high profitability, that's what makes it feel less like a risky startup and more like a really scalable fintech platform.
So the big question then is, how? How are they generating this? Because the engine is still transaction-based, right? It's heavily driven by specific segments.
It is. And that's where the risk argument comes in, but it's also their strength. If you dig into the numbers, crypto and options trading,
A volatile stuff.
the really volatile stuff, yeah, they accounted for $572 million of the total $730 million in transaction revenue.
So a huge chunk.
A huge chunk. And what this confirms is their ability to capture that episodic volatility in digital assets.
Yeah.
That's their key differentiator from, say, a traditional broker.
Okay, but a lot of people would say that's a weakness. That reliance on crypto and options, isn't that just a ticking clock until the next bear market?
It's a fair point. But the real long-term advantage, the competitive moat, lies in the user ecosystem.
The network effect.
The network effect, exactly. How strong is it?
Well, they have over 30 million funded accounts. I mean, that brand dominance among younger, tech-savvy retail traders is massive.
It is, and it's not just about, low switching costs for the user. It's
Yeah.
about the high friction for competitors.
Right, like for a Fidelity or a Schwab to try and replicate that mobile-first kind of gamified experience, that's really hard.
It's incredibly difficult, and the sophistication goes beyond just the interface. They have a huge data advantage.
What do you mean by that?
They have these deep insights into retail trading behavior.
Yeah.
They know what people want before they want it. It allows them to optimize product offerings, which, supports higher monetization per user.
Which reinforces their position.
Exactly.
Quick point on financial health, though. How's the balance sheet if things do get rocky?
It's robust. They're generating substantial free cash flow. They're doing share buybacks.
Okay.
And some analysts are even talking about the potential for a future dividend, which would completely change their investor appeal.
A dividend would be a game changer.
So let's look at how the market reacted to all this. After those earnings, what did the stock do?
Well, post-earnings, the price action was very strong, very positive.
Yeah, I saw that. There was a notable after-hours gain of over 4% right after the Q3 beat.
Right, and if you look at the chart, the stock is trading above its key moving averages. You've got the 50-day at 133 and the 200-day around 108.
Which signals a pretty strong bullish trend, right?
Yeah.
An accumulation phase.
Mhm.
It does. It signals that big money is buying in. And that speaks to the market perception, which seems to be shifting.
How so?
We're seeing major institutional buyers either increasing their positions or starting new ones. Big wealth managers, asset managers like Pinnacle or Ritholtz.
So the smart money is coming in.
They're allocating capital here. Now, we do have to acknowledge the recent insider selling.
Right, I was going to ask about that. A couple of executives sold off, $6.5 million and almost 16 million worth of shares? That always looks bad.
It does, on the surface. But this is viewed more as normal diversification. Their personal wealth is so tied up in the company.
So it's not a red flag, necessarily.
I don't think so. The institutional accumulation, that's the much stronger bullish signal here.
And this confidence is being reflected in what the analysts are saying, too.
Absolutely. We've seen significant upward revisions in price targets. Some firms are now suggesting targets as high as 155, 157, even $168.
So a lot of upside potential from where we are now, according to them.
The consensus certainly implies that, yes.
So let's just sort of take a step back. We've got massive growth, expanding margins, institutional confidence, but we always have to look at the downside. What are the key risks here?
The primary risk is the one we touched on earlier. Volatility and concentration.
The reliance on crypto and options.
Right. A huge chunk of their growth is tied to these highly cyclical products. So if we see a sustained crypto bear market or, some kind of severe regulatory action,
We could see a sharp decline in that transaction revenue. We've seen it before.
we saw a dip in mid-2025. Exactly. Now, they are trying to mitigate this. They're diversifying into things like prediction markets and wealth management.
But that's still early days.
Very early. Which
Okay.
brings us to the second major risk,
Which is?
valuation.
It's expensive.
It is. The market is pricing in a lot of future growth. The stock's currently trading at a PE of what, 54? And a price of sales of 27.
And what's the historical average for the PE?
It's around 10 or 11. So it's way above its average. So if that growth slows down, even a little bit, or if macro conditions get worse,
You could see a big drop.
you could see significant multiple compression. That could lead to large drawdowns. We're talking 40, maybe even 60% if you look at what happened in 2021 and 2022.
Okay, so that's the bear case. But despite those risks, there are some pretty clear near-term catalysts that could drive the stock even higher.
There are. The next major event is obviously the Q4 2025 earnings report. That's expected in early February.
And the consensus is already pretty high for that, isn't it?
It is around 40 to 50 cents for EPS and revenue between 1.15 and 1.25 billion. If they can beat that.
The stock could pop again. What else?
Guidance. There should be an investor day or an earnings call in Q1 where management gives updates on new initiatives.
Like those prediction markets, or maybe international expansion into Europe or Asia.
Exactly. Any concrete plans there would be a huge boost.
Yeah.
And then there's the macro picture.
You mean the Fed?
Yeah. A potential Fed rate cut cycle in 2026. That could boost risk appetite across the whole market. And, of course, if crypto prices surge again.
That directly juices their highest margin business.
It's a massive tailwind for them.
And what about that speculative talk? You always hear these unconfirmed rumors.
The M&A chatter. Yeah, it's always there. Rumors of interest from larger financial firms who want to buy that user base and that tech stack. It's not confirmed, but it definitely highlights that potential upside.
It kind of puts a floor under the price, in a way.
You could argue that. I mean, the overall investment thesis really relies on continued strong execution and whether this narrative shift from a volatile app to a profitable fintech platform really sticks.
So given the current momentum and all that institutional support, it seems like the bulls are in control for now.
It certainly carries a strong bullish score at the moment, yes.
It's a fascinating company to track. Ultimately, the question for you, the learner, isn't whether this platform is profitable today. That 52% margin pretty much answers that. But whether a business built on monetizing high-risk retail speculation can truly transition into a stable, diversified investment platform without losing the very user base that makes it so valuable. That challenge is what defines its next chapter.
If you enjoyed this analysis, please make sure you subscribe, like, and comment below to stay on top of the latest stock moves. We'll see you next time on Smart Wealth with Joshua.